Hello, just wanted to give my commentary on what has happened last week. Yes, the Fed finally cut rates. Whoa, man, so excited. And would you believe it? But mortgage rates went up. Yes. Uh, how would anyone have called that? Pretty sure I called that. So, yes, it is the Fed funds rate, as I've said, I don't know how many times, y'all probably those of you that listen to me and get my updates are probably tired of hearing it, but the Fed funds rate has nothing to do with mortgages. It affects other rates. It doesn't affect mortgage rates, especially not directly. They're trying to influence other things, which we'll get into, obviously. But mortgage rates went up last week. That's correct. Now, preface that to say we are in a really, really good spot. So it's not like rates just spiked last week because the Fed funds rate went down. This is the Freddie Mac survey. This is just the last year average mortgage rates. The blue line is what we're going to focus on. The blue line is a 30-year fixed. The green is a 15-year. So as you can see, we've had this downward trend, which has been nice. And since really the last 4 months, since May, we've had a really quick decline in mortgage rates, almost a full point on the average mortgage rate over the last 4 months, which is a really quick decline. It usually takes more time for mortgage rates to really trend all the way downwards. Now, so we're in a really, really good spot for mortgage rates. Why did the mortgage rates go down when the Fed funds rate was still high? The reason is because inflation is trending back downwards again. We had some inflation reduction, and when we say reduction, de-inflation. So the rate of inflation is not as high as it used to be, but we still have inflation, right? So, but some inflation is good. A growing economy needs to be able to expand, right? So, but we had, this, at the end of really, really high rates, because inflation was real sticky at the end of last year. It kind of started coming down. And everyone right here, beginning of the year, everyone thought, oh, we're out of the woods because rates were coming down. But inflation was kind of holding here. And now, and then in the spring, inflation started coming back down to the 3.2 mark that I like to use core CPI as my measure. So that's why rates have come down, right? Now, if we look at the last week's 10-year treasury yield, we see that this was last week and up until yesterday right here. 10-year treasury yield, this is what mirrors mortgage rates more than anything else. Right here is right when it was announced and after the Fed press conference, mortgage rates went up. There was a lot of things that I think Chairman Powell said that maybe investors didn't like too terribly much, but mortgage rates went up. Now, why did they go up? The reason being is mortgage rates track with inflation more than anything else. That is the driver. Inflation makes the cost of goods and services go up. Mortgages, you're just buying money. That's all you're doing. It's still a product. It's still a service, right? So inflation has been going down, which is good. Also, too, mortgage rates react to strength or weakness in the economy, but usually when the economy is weak, inflation is going down, so therefore mortgage rates go down as well. Now, the thought process is behind a high funds rate to fight inflation is that the higher the funds rate, or keeping it high, this high, up above 5% for that long, sucks money out of the economy to thereby hopefully bringing inflation down. It's taken a while, but inflation is coming down. So therefore, with that thinking, if you lower the funds rate, you're not fighting inflation anymore, which is what Chairman Powell actually said during the press conference. Thereby, inflation may hold, or maybe it'll go up. You never know. And that's why investors got a little bit, I think they probably just are just hedging their bets. It's probably what they're doing. So that would be the reason for rates to go back up. And then over this whole last week, we just seen bounces back and forth because, is inflation going to keep coming down? We keep getting all these conflicting reports. The job reports are completely fake. And the problem is that all of these people in the media, the pundits, all that saying that the economy is resilient. Of course it's resilient. At the end of the day, American people are going to work hard and keep pushing forward. So we're resilient, fighting against all the stuff that you're doing, right? So the economy is resilient, it's strong, all these kind of buzz, but the jobs numbers are fake. they took a ton of people off the job rolls, just eliminated them, saying they're not looking anymore. So the unemployment rate can stay at 4.2%. So we have all these conflicting reports. Jobs are not being refilled. They're not firing people yet, but they're just not rehiring. So it's reduction of workforce through attrition. So all these little bitty things that you see at the beginning of a recession. So you have all these conflicting data. So that's why you see here the market just doesn't know what to do with itself, because you say the economy is strong on the one hand, but then we see that get the report on all the job gains in the last year have been to foreign-born workers and not Americans. That doesn't sound like a strong economy to me, right? So you see rates go back and forth, up and down. So I think the not just the mortgage market, the long-term investment market, the safe investments, right? Your treasury yields, mortgage-backed securities, stuff like that. They're trying to figure out what the next step is. That's what it is. And they're getting conflicting data. So I wouldn't be surprised if they just kind of hedge their bets right now. Try to figure out what the next step is, which would be the next jobs report and the next inflation report. That's what the next steps would be. But again, if you're in the market, you've been on the fence, to buy a home, then now is a great time, because as you can see, we've got mortgage rates have come down. Now is the time to strike, right? Rates are down at their lowest levels probably since the beginning of 2023. I personally think that they'll probably kind of plateau for a little bit, as like I said, wait for more data. Obviously, election coming up, so you're going to be a little bit, just kind of figuring out what the future looks like, what 2025 looks like. So, but yeah, we're in a great spot. There's homes on the market right now, so a lot of motivated sellers. So now you're going to get to be able to take advantage of those savings by having a lower rate than you would have at the beginning of the year. So yeah, jump in. Save that money by having the seller pay closing costs. That could be a good advantage for those that are still kind of in the market. So that's where we are on mortgage rates itself. I went through and watched Chairman Powell's press conference. There's a few things that I kind of take, and I don't care. So here's the thing. I don't care what the federal funds rate is. Honestly, I would have preferred they kept it high. I would have preferred it to be still at 5% or 5.5%, whatever heck they were thinking, right? So they lowered it to 4.75 to 5%. So I would prefer them to stay high, because if they keep it higher for longer, then that's their dedication to fighting inflation. But they're talking out of both sides of their mouth when they're saying that the economy is resilient or the economy is still strong. Because if the economy was still strong, they would not have cut by 50 basis points. The 50 basis point cut as the first cut in the cutting cycle is you're kind of tipping your hat, right? Like you're telling the batter what the pitch is, right? So fastball coming in. That's what they're saying is that 50 basis point cut at the beginning of the cut is a good and aggressive cut, which means that they're worried about the economy, despite what they're saying. And so that's the part of it that we see moving forward is the economy could be in trouble. We could be looking at a recession. Now, going back into the real estate side, the mortgage rate side, typically recessions are deflationary, and lower inflation means lower mortgage rates. So therefore, that could be good for anybody who is jumping into the market, especially if you're in, a recession-proof type of job. And I honestly don't think that. I mean, the unemployment's still low, but we're probably not looking at. If it is a recession, it's probably a little blip. We're not looking at something. I don't think we're looking at something catastrophic like the GFC, 2008 and stuff. So, but and of course, there's so many people right now that they have their 3% mortgage rate. They're in the house and they want to stay in for a long time anyway. So, there's not a lot of attrition that's going to happen there either, I don't think. But going back to the press conference, so a few things that I wrote down that I kind of wanted to point out, because like I said, I don't care about the actual funds rate itself. I care about what they're saying, the little comments that are made, and reading between the lines of what they're actually saying, and not what they want people to hear, right? Okay. First point that I want to kind of touch on from press conference.
Toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed.
2.2%. It's funny how he said estimate it 2.2% because there aren't any reports that says inflation is 2.2%. Or CPI is 3.2. That's everything minus food and energy. All items, though, so the CPI with food and energy, everything is 2.5%. And the only reason why CPI, all items CPI is down is because energy costs are way down, which we know that's pretty volatile. You never know what's going to happen there. That's part of the reason why we had a lot of inflation in 2022 was because of energy costs going up so much, and that kind of trickles into everything else. So if energy prices stay down, then that will help, cool everything else as far as inflation goes. But he says estimated 2.2 because they want to say that they're close to 2%, and that's their goal. So they need that to provide cover for this 50 basis point cut because and notice how he said overheated state for the jobs market. Why? I'm sorry. Overheated cannot be a term you use for a jobs market, right? You want it to be strong, right? You want it to be growing and booming. That's what you want. You don't want it to be overheated. And does overheated mean people coming back from COVID, from Democrat states forcing businesses to close and not stay open? Is that overheated? What's the overheated, right? So yeah, I think that's what they need. They need inflation to be down. Their goal was was 2% before they cut, and they're cutting before that because the economy is telling them that we need you to cut so that short-term rates that are more closely tied to the federal funds rate can come down to make it easier for businesses to stay open. So which side of their mouth are they talking out of here? Are they saying that the economy is strong and great, or are they saying that it's in trouble? Because strong and great is over here, 50-point basis cut is over here. You can't have it both ways, right? So, all right.
Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%.
So they're basically saying that they think they've done the job, right? That it is sustainably going down towards 2%. That's what they're saying. What they're really doing is they're hoping. That's what they're hoping. And I hope too. I do. I want inflation down because I want mortgage rates to come down. But this is what we're kind of reading between the lines here on the press conference. And so, and I say all of that because you never know what the future holds. None of us can ever truly predict what is going to happen, right? It's all about the probabilities of what the data is telling us and what those probabilities are, right? And so my thought process right now, as someone in the mortgage industry, someone that deals with the realtors and people in the real estate industry all the time, is rates have come down. It may take longer for them to come down if they do, but again, we never know. Is it going to plateau? Is it going to plateau off? And right now, there are really good deals to be had on homes that have been sitting on the market. So if you really think about the timing of this, mortgage rates are down to the lowest levels in probably the last 15 to 16 months. You're going to get a good deal on a house, and or seller's going to pay closing costs, which is somewhere between $7,000 and $10,000 still in your pocket. Is $10,000 still in your pocket worth waiting to see if rates are going to come down again? And then what happens if they do come down and we jump into a more heated sellers market, and a more competitive market? That's the best way to say it. We get into a more competitive market where now you have to make a more aggressive offer. Now that $10,000 is not in your pocket anymore. You got to pay it because pay all the closing costs, and maybe you have to actually make an offer that is higher than what you would have 9 months ago or 6 months ago, whatever that was. So again, none of us can be certain what's going to happen, but that is a potential scenario. And I always like to say, better safe than sorry, right? If you're ready to buy, now's a great time with low interest rates. Get in there with a good deal. And if something does happen, if rates tank, then you can always refinance negotiate a little bit, mitigate the cost of the refinance, and realize even more savings than what you would have if you bought later on.
As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance. And we are attentive to the risks to both sides of our dual mandate.
So this is what I said before is he is stuck. They are stuck between a rock and a hard place. They really are in a bad spot. And some of it they brought on themselves. They've allowed this, quantitative easing to go on, doing things that they really aren't part of their mandate, monetizing a lot of the debt and letting that kind of get out of hand. But now they're between a rock and a hard place. Now, they are saying that inflation risks have eased, and now it's time to shift our focus to the economy and employment. So, but that's where it is, because you can't fight both at the same time. And that was what the whole idea was. He said overheating job market. They use the word overheating job market so that to again give cover to raise the funds rate, because he flat out said a year ago or so that he wants. I mean, he didn't flat out say it, but that's just a part of the consequences of doing that is potentially the unemployment rate would go up. So, but now they don't want it to go up too much. So they're kind of stuck there. So what they're saying is they hope that inflation just does continue to go down and they hit that target. And now can they cut fast enough to avoid a lot of layoffs and avoid a recession? So they're really, really in a tough spot on that. Personally, I think that you just need to take your medicine. Sometimes you get sick. You just got to take your medicine, try to recover as fast as you can, right? Nothing is ever perfect. The economy is very cyclical, so sometimes you just got to accept that fact instead of prolonging it. That's what happened. The 2008, the financial crisis was prolonged. That was what happened in the Great Depression. Massively prolonged, because they kept trying to fix it instead of getting the heck out of the way and let the country fix itself. So next thing, let's see here.
The evolving outlook and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate
here's the dot plot.
federal funds rate based on what each participant judges to be the most likely scenario going forward.
This is totally typical. No one is going out on a limb at all. And basically what they're projecting here is that they will cut 2 more times, just on average. That's what they're predicting here. As you can see, most of them are predicting 4.25. We're at basically, 4.75%. We're basically right here. They're basically predicting right here. So they're predicting another half base point or half point, 50 base point cut by the end of the year. There's 2 more meetings, so it could be 25, or it could be 50 basis points at one of those. That's what they're projecting. And they're projecting another full point by the end of next year. So they're projecting 4 25 basis point cuts throughout next year. So again, a lot of times economists like to do that. My brother says this all the time. Economist projections are always in a straight line. And that is kind of what you see here. Like they're literally going, yeah, they're going on a straight line. And then what they're thinking is, of course, longer run, they can't get out on the limb at all because there's still a lot of uncertainty as well. So, and this is kind of normal. This would be in more of a normal range anyway for a Fed funds rate, historically speaking. A Fed funds rate down at 0, at 0.5% and stuff like that. Like we saw a lot during the Great Financial Crisis, 2010s, and then just, COVID was very, very odd. That's not normal. So this is them trying to get back down into a more neutral stance. Let's see.
Does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
So I would say we don't think we're behind. We do not think we think this is timely, but I think you can take this as a sign of our commitment not to get behind. So it's a strong move. So your other question was?
Yeah, Steve. So some of the question they're already kind of wondering, like, did you make the cut too late? Right. That's what they're thinking. But to be fair, they couldn't. And like I said, I want them to keep it higher for longer because I want inflation to keep going down. The bad sign on the other side is that it may affect job gains and where we're at right now as far as job gains. I've said this before. It's a signal that a recession is starting. Is that the unemployment rate has gone up by the Sahm rule was triggered last month, which is the unemployment rate, the 3-month rolling average on the unemployment rate has gone up by more than a half a point within the last year. So that's one of the it's not a trigger, it's a correlation to the start of a recession. So another correlation to a start of a recession that you always see is businesses don't fire people before a recession. They fire people during a recession. What's happening right now is reduction of their workforce through attrition, basically meaning someone has left that job, someone's retiring, and they're not going to refill that position. That's what they're doing right now. So, seeing if they can have 2 people do the job for what used to be 3, right? So trying to be more efficient, which in this day and age, with everybody working from home, being less efficient, you can probably make that case, right? So, but that's what they're saying right now is so they're already a lot of people, and this is what investors see. Investors are seeing, okay, are you behind? Should you have done this sooner? That's why mortgage rates have probably helped because hold on, we're not there yet. You said you're going to get to 2% inflation. We're not there yet. So that's kind of where they're at on that. And then there was one more like little bullet point.
You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
Again, the labor market is actually in a solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there.
See, and that's where investors, they see 2 conflicting statements, basically. Yeah, the labor market is in solid shape. Well, the economy is in solid shape. It's not a big, growing, booming economy, and they're projecting that. They're projecting a 2%, like 2% GDP growth. That's what they're projecting. And of course, what she was saying is how are you projecting 4.4% unemployment as a sustainable level when unemployment is going up and you're cutting by 50 basis points, which is an aggressive move for the first move. So which one are you really? What's your tell? Are you tipping your cap, right? Which way are you going? And that, so to say all of that is to say that investors, the guys running the big hedge funds, the pension funds, right? The ones that are moving billions of dollars around. And a portion of those, probably a good portion of those, need to be in safer investments, which is treasury yields, mortgage-backed securities. But it's not just this stuff domestically too. Like they can invest anywhere they want all over the world, and there's a lot of other safe investments. And so when you're trying to gauge, okay, what is my return going to be on one of these low yield investments that are super safe, trying to get some information from you, right? Are you worried about the economy, which would, then, force me to move money away from one investment or another? Or are you worried about inflation still? Which one are you worried about, right? And they're trying to say that they're worried about both when you can't have it both ways, right? So, but having said all that, a lot's going to happen over the next couple of months anyway. So we definitely know that. We'll see how inflation comes out and unemployment comes out next month. And then obviously the election in November, which will pretty much guarantee what type of path our economy is going to be on. And I will say this, like I said before, if we are heading into a recession, then that typically does mean inflation comes down. So that could give relief to people who are really kind of struggling buying all the goods and services they need right now. Obviously, mortgages hopefully keep coming down to make housing more affordable. And then if it is a recession, hopefully we do come out, really quickly and kind of bounce back. And then hopefully we have a booming economy where everyone can maybe take advantage of a more affordable housing market after that too, right? So, but that's my take on what happened last week, why things have happened, though they happened a little bit on the mortgage side, because we're still kind of holding a little bit higher. And the thing is, we mortgage rates went down by about a full point from May, and then they ticked up about a quarter point after the press conference, after the Fed announcement. So we're still 3/4 of a point, 7/8 of a point improved, probably a full point improved from the very start of the year. So mortgage rates are in a good place, and they've already come down. Everything, the economy, and I say this to a lot, the market influences the Fed, right? The Fed does not influence the market, right? So the market is telling the Fed, okay, now you can do this or that. It's not the other way around, right? So there's so many forces at play. And I think that 12 guys sitting on a board can just determine what happens all over the place is not realistic. But continue plugging away. We'll be back here again, just trying to dissect all the information so that all of you on the ground can look through all the noise, see beyond the rate, and see how it's going to affect you in your daily life.